All right, welcome to Prepay or Prepare to Pay Tax Planning for Students. This is our first Get Savvy, Grow Your Green Stuff webinar in this year's series for 2025-2026. My name is Andrea Pellegrini, and I run the Student Money Management Center out of University Bursar for the entire University of Illinois system. And I'm joined today by my colleagues, Mandy and Kathy. Mandy, do you want to introduce yourself?
Yes, my name's Mandy Alt. I am a senior instructor in the Geese College of Business. I teach tax classes, and I also run the Campus VITA program, which is our volunteer income tax assistance program. Kathy helps me with that. I'll let her introduce herself as well.
Hi, this is Kathy Sweetler, and I'm very happy to be here. I work with Mandy, as she said, on the VITA Volunteer Income Tax Assistance Program as the site coordinator, and I hope you all get great information from this webinar. I know I've already learned things.
Thank you, Mandy and Kathy. This is really the Mandy show, and Kathy and I are here to support Mandy in sharing her extensive knowledge about tax planning. But we'll move ahead. So collectively, the Get Savvy webinar team represents organizations across the state of Illinois, which rest on the ancestral lands of multiple Native nations, including the Peoria, Kaskaskia, Piankashaw, Wea, Miami, Mascoutin, Ottawa, Sauk, Meskwaki, Kickapoo, Potawatomi, Ojibwe, and Chickasaw nations. And we have a responsibility to acknowledge these Native nations and work with them towards a more vibrant and inclusive society. So I did mention before we started the recording that we like to use the chat, but we also like to use polls. So we're going to poll the audience today. Just a little demographics poll to let us know who's joining us. We know that there's a diverse amount of people that were interested in this particular webinar. But this helps us kind of track who's attending the webinars and gives us some context for how to modify some of the things that we talk about. So there's some information on like your age, what your employment or student status is, which university or Get Savvy collaborator that you are affiliated with, and that's going to help us with all of our collaborators across the state and kind of seeing what our outreach numbers are for those different collaborators. And any information that you can share is extra helpful. In when you do finish with the demographics poll, as you scroll down, you might have to hit the submit button. We have about 64% of you that have participated so far, so I'll leave that open for a couple more seconds, but we have a lot of information to go over today, so we won't spend too much more time on this. All right. And in the poll, I'm just sharing the results real quick. It looks like most of our attendees are between 18 and 34, but we have several of you in the 45 to 54 range. Most of you are students, but there are some full-time employees, part-time employees, and even a partner of a student, which we really appreciate. We need all the support we can get when we're going to school. Most of you are from Urbana or Chicago, or other organizations, and most of you are women. So that's good to know. And I'm going to stop sharing if that bar is still up or that that poll is still up. You can exit out of it and the next one will pop up later. All right. So I think I get a hand over to Mandy now.
All right, great. Thank you, Andrea. And I'm happy to be here. As Andrea said, I've been working in the field of tax for about 30 years. I had my background in public accounting, and I had a tax practice before I came to teach in 2018. So while I have a lot of background in tax, and I'm going to share some of that with you today, I actually am not able to give specific tax advice. We'll cover some basic tax information, but if you have questions about your specific tax situation, I'd invite you to join us at the VITA program. We'll get started in February, or seek out a paid tax professional for those. All right, so today we're going to do a few things. We're going to understand just the basics about how do we calculate our tax liability, what is taxable income, how do we know how much to pay, and then what we're going to spend most of our time talking about is the how do we prepay those taxes. It's a requirement to prepay your taxes, and so how do we do that? We'll spend a little time then also focusing on, since most of you are from the University of Illinois system, focusing a little time on how some of that works here at the University of Illinois, and then provide you some resources that you can use for your further education on this topic. All right, so another poll for you. We'd like to know a little bit about what kind of income you have. So what kind of income you have sometimes can make a difference in how you are going to prepay your taxes. So it would help us to know, do you have, are you an employee? Do you do contract work or gig work? Do you have scholarships, fellowships, stipends? What kind of income do you have? And we will focus on those as well. Looks like so far we've got most people are employees. We've got some people with some fellowships and scholarships and grants supporting their education. A couple of you are doing some contract work or gig work.
It looks like responses have kind of leveled off, so I'll go ahead and end the poll and just share the results real quick. So like Mandy said, most of us are employed, but we have kind of the range represented in today's participants. I'll go ahead and stop sharing and give you back the floor, Mandy.
Great. All right, so again, what kind of income you have can make a difference in how you're going to pay your taxes, but generally everyone pays their taxes and calculates their taxable income in the same way. So this is the basic tax formula. This is what you will do when you're filing your tax return. You're basically walking through the steps of this tax formula. So the first step is to figure out, okay, what kind of taxable income do I have? And then from that, you get to subtract certain deductions, and that is going to give you your taxable income. Your taxable income is going to be taxed at different tax rates depending on a few things, one being your filing status, and then the other being the amount of income that you have. So you'll calculate your tax liability, but not everyone, but most people are eligible for some tax credits that will reduce your tax liability. And that brings you to your net tax liability. We actually did a webinar on this last year that we'll share the recording of that. If you need help kind of walking through some of that, that's done in more detail in that webinar. But what we're going to focus on today is that net tax liability. You cannot wait until the end of the year to pay it. You need to prepay that throughout the year. And so we're going to talk about how do you do that. So some of you are new to campus now. Maybe things are changing with regard to what kind of income you have, and it's time to plan to make sure that you don't get surprised later in the year. So we're going to focus this webinar on how do you do those prepayments. There are two ways: tax withholding and estimated tax payments. And again, you're required to do that. And you'll do that throughout the year. And at the end of the year, then you'll figure out, okay, what was my actual net tax liability? And did I overshoot or undershoot? Did I pay too much during the year? Did I pay too little? If you paid too much, you're going to get a refund at the end of the year. If you paid too little, you're going to owe more tax. But in addition to owing more tax at the end of the year, if you paid too little throughout the year, you can also get penalties. So today, our focus is to educate you so that you're not surprised at how much you owe at the end of the year, for one thing. And then the other thing is just to help you avoid being hit with those penalties if you don't pay enough. So understanding your income tax responsibility is our focus. Again, this webinar is going to be focused on your responsibility for prepaying your taxes. So again, your net tax liability is what you are going to pay in taxes each year. That is your tax calculated on your taxable income, which again is income minus certain deductions that you might be eligible for, and then minus any credits. So the net amount that you owe for the year is your net tax liability. You have an obligation in the US to pay that throughout the year. It's called a pay-as-you-go system. So you can't wait until the end of the year and report, okay, this is how much income I had. I'm eligible for these deductions and credits. So here's my net tax liability. And now I'm going to write a check or make a payment in some way to the IRS at that time. You have to estimate what you owe and pay it throughout the year. There are two ways this happens. Employers or other payers will sometimes withhold taxes. What that means is that the person that is going to pay you money will calculate a certain amount of tax withholding, and they will hold on to that amount, and they will give you the net amount, your net payment, and the tax payment they will send directly to either the IRS or the state, depending on what kind of tax it is. That happens for certain payments, but not all payments. And sometimes the amount that is paid is not always enough. And so the other way you can prepay your taxes is through quarterly estimated tax payments. That's a payment you make directly to the IRS or to the state on a quarterly basis. And so that is something that you will need to do if your tax withholding is not enough to cover your net tax liability for the year. So withholdings again are when a payer retains a portion of a payment that's owed to you and remits it to the IRS or again to the state. We're going to talk about this from the perspective of the federal tax today, but the same is true for a lot of states. The payer is going to retain some of the payment and give it to the IRS to be held in an account for you to satisfy your prepayment of taxes. So withholdings are a requirement for your employer. Your employer must withhold taxes unless you report that you're exempt from withholding, and we're going to talk a little bit about that. But it's required for employers to withhold taxes on your paycheck. It's optional for other kinds of payers. So if you get retirement income, most of the time you can elect to have taxes withheld, but it's not a requirement. So unless you ask them to do that and they're willing to do that, it's not going to be done. And gig work, contract work, taxable education assistance like fellowships, none of those will have taxes withheld unless you are a specific kind of taxpayer. You need to be aware that though those things are taxable, they may not have taxes withheld. So you may not be prepaying your taxes on those. The exception is for some non-resident aliens. There are some requirements for all payers to withhold taxes if you are a non-resident alien. We won't go into that in this webinar, but I know you can get some assistance through having an appointment that Andrea will talk about later. All right, so just a quick example of how this works. So let's say Marco is working. He's an employee, and his employer owes him $1,000 for the current pay period. The IRS or the employer, I'm sorry, is going to use an IRS calculator, and it's going to tell them based on some information you report to them about your situation. It's going to tell them how much tax to withhold. So Marco's employer does this, and it says that they must withhold $200 of tax. So what's going to happen is Marco's going to receive his paycheck for $800. That's his net pay. The IRS is going to receive a payment of $200. That's Marco's prepayment of his taxes on that $1,000 of income that he had. So the IRS is going to hold on to that money, and they're going to give Marco credit on his account that says he's already paid $200 of his tax for this year. And then at the end of the year, he's going to reconcile and see if that was the right amount or if he needs to pay more, or if he paid too much, he'll get a refund. Okay, so Marcos will likely have other taxes withheld from his paycheck as well, and other deductions, things like state income tax, Social Security and Medicare taxes. We won't talk about all of those, but there are more deductions and from your gross pay than just federal income tax. But that's the essence of how this works. All right, so understanding your gross pay and your net pay. When you are an employee, what you earn from your employment, whether that be an hourly wage or a salary, that's your gross pay. What your employer has agreed to pay you for the work you're doing is your gross pay. But if you have been an employee before, you know that's not the same as what your paycheck is. Your paycheck that you get, the actual money they give you, is what's called your net pay. And the reason it's different is because there may be certain things that they're providing to you that are taxable they're not providing you in cash. So certain benefits your employer provides to you are going to be taxable, but they are not given to you in cash. That those things get added to your gross pay when calculating what is taxable to you. Another reason why your gross pay and your net pay are different is that what we just talked about, these withholdings where the employer is going to keep some of your money and give it to people that you owe money to, like the IRS for your federal income tax, the state for your state income tax, the IRS and Social Security Department to satisfy your obligation to fund the Social Security and Medicare system. And then there will also be some other deductions, like maybe you have to pay a portion of your health insurance, or those of us who are employees at the university, we know we have to pay for parking if we want a parking space. Those things are going to be deducted from your gross pay, and your net pay is going to be what's left. So this is an example that looks very much like an earnings statement for employees of the University of Illinois that shows your gross pay, your deduction for things like federal withholding tax, state withholding tax. You'll notice a zero in the they call it on our earnings statement old age survivor disability insurance, but yesterday when we were meeting, we agreed that that's a terrible name. It's Social Security tax. We don't like to be called old age as we get to this age, but the deduction, these are all things that the employer is going to deduct from your pay, and your net check is going to be the difference between that gross pay and all of these things. What you want to pay attention to on this particular, on your earnings statement, what we're talking about today as prepayments and withholding are these federal withholding tax. So when we say you have the obligation to prepay your tax, you're going to estimate how much that tax liability is and pay it throughout the year. Your federal withholding tax that you see on your earnings statement is your prepayment of tax. So that's one way to prepay your tax, and that's where you can find the amount that you have prepaid is by looking at your earnings statement for the year. So I'm going to turn it over to Andrea to talk a little bit about how tax withholding works at the university for different types of employees, because I know we have a lot of students on here. So Andrea, I'll let you talk a little bit about that.
Thank you so much, Mandy. So we really want to emphasize that employee names and types are going to differ based on what kind of employer that you work for, but this is related specifically to the University of Illinois system. So the taxes that are withheld from your pay differs depending on a whole variety of factors, but particularly by the employment category that you fall within. And there's even more employment categories and names than just these four, but these are what we're going to talk about right now. So federal and state taxes and some FICA taxes, specifically Medicare, are taken out of all employees' pay. But if you're a student employee that's enrolled at least part-time, which is about 6 credit hours for all the University of Illinois universities, no FICA taxes are withheld. However, if you're enrolled less than part-time, like over the summer break, for instance, FICA taxes are withheld from your pay. So you might see some variance in what your take-home pay ends up being because that particular aspect of withholding is different. If you have a fellowship, it is not considered employment, so no withholding occurs on either your monthly stipend or your waivers, which is considered a benefit depending on employment type, but it's not employment if it's a fellowship. However, if you're a foreign national, like we talked about earlier, withholdings all kind depend on your residency status, your tax treaties, and your visa type. So if you are a foreign national and you have any type of income through one of these methods, like fellowship, student employment, or even a full-time employee, what they do is they tax at the highest possible rate until you do a tax status review with university payroll and benefits. So we're going to share more information in the chat and when we send a follow-up email to all the registrants with the recording about how you can look into that if you are a foreign national employed at the University of Illinois. All right, I'll hand it back to you, Mandy.
All right, thank you, Andrea. So, like we were just talking about, what we were just talking about is withholding tax. So you can have prepayments of your tax done by your employer or sometimes other payers through withholding. If that's not enough, then you would be required to make quarterly estimated tax payments. So a quarterly estimated tax payment is just a payment that you make. These are due at 4 different dates throughout the year. So the first one is due April 15th of the current year, June 15th for the second, September 15th for the third, and then the fourth you have until January 15th of the following year. So for 2025, we've already passed the April 15th and the June 15th deadline. We have another deadline, September 15th. So if you think that you might owe some estimated tax payments, and you didn't know that before now, the recommendation would be to make that payment as soon as possible for the first 2 quarters, and then starting the third quarter, September 15th, you can get on track. So if we get through this webinar and you get a little panicky, like I think I might owe some of these, you can do that. The other thing I will tell you is that you won't be penalized if you fail to pay quarterly estimated tax payments the first year that you are required to. It's only if you continue to do so after the first year. So don't panic if this is maybe your first year of receiving a stipend that might be taxable and you didn't know that. You wouldn't be penalized the first year of not paying these payments, but going forward you need to. So a quarterly estimated tax payment is something that someone would need to do if they do not have tax withholding that is enough to cover their tax liability. So we're going to talk about how do you know that and who might need to worry about that in a minute. But basically, making a quarterly estimated tax payment just means that you're estimating how much tax you think you owe, and you're subtracting from that the tax withholding that you expect to have by the end of the year. And whatever difference is there, you're just going to take that and divide it up into 4 quarterly payments and make those payments by this due date. You can mail a check to the IRS. There are ways to do that online, but you're just going to make those payments by these deadlines. So if Marco, in addition to being an employee, has done some gig work, his $200 that he prepaid in taxes through his employer is going to be enough tax to cover those wages. But if he has other income on top of that without tax withholding, he needs to estimate and determine, is his tax withholding going to be enough to cover the tax he owes on all of his income? Okay, so sometimes it is, but not likely. If you have income with no taxes withheld, it's likely that you're going to need to pay some quarterly estimated tax payments. So he's going to need to estimate his total taxable income. We've talked about the tax formula earlier, and figure out if the tax he's going to have prepaid through withholdings is going to be enough to cover his net tax liability. If not, he'll make those payments. But to estimate his income, his taxable income, he's going to need to keep good records of his income and then also his expenses if he's doing gig work. So part of this whole process is understanding what is taxable income, what kinds of things are deductible expenses, what kind of tax credits might you qualify for. Again, we have another webinar on that, but on a quarterly basis, he's going to calculate, okay, how much tax do I think I'm going to owe this year? How much taxes have I had withheld from my paychecks already, and the shortfall is going to be what he's going to pay as a quarterly estimated tax payment. So obviously, this is all a very uncertain process because you're doing this throughout the year and you don't know for sure what's going to happen throughout the year. So right now, if I were estimating how much tax I was going to owe for 2025, I know for sure what my income has been for the first part of the year, but I don't really know what it's going to be for the last part of the year. I don't know what deductions I might have for certain. So it is an uncertain process. You're working with estimates, but you don't need to worry because at the end of the year, your tax return, the whole purpose of your tax return is to reconcile, okay, here is my actual taxable income. Here are the deductions and tax credits I'm actually due. So now I know what my actual tax liability is, and then you are going to report, okay, here was my actual net tax liability, and here's how much I prepaid through tax withholdings and quarterly estimated tax payments. And if you paid too much, then you are going to get a tax refund. If you paid too little, then you'll owe additional tax at that time. So if Marco works the entire year doing both jobs, and his employer by the end of the year has withheld $16,000 of federal income tax, and he has made $6,000 of quarterly estimated tax payments. Again, he would do that by writing a check or paying online to the IRS $1,500 by April 15th, by June 15th, September 15th, and then January 15th of 2026. At the end of the year, he is going to do his tax return and figure out how much he actually owes. So he, throughout the year, was estimating that he owed $22,000. He paid $22,000 throughout the year. At the end of the year, he is going to complete his tax return. And let's say he realizes when doing that that his net tax liability is actually $20,000. Then when he files his tax return at the end of the year, he's going to get a refund of $2,000. So let's take a little quiz. If Bob estimates his tax liability to be $10,000 and he wants to know if he's going to owe money when he files his tax return, which deduction on his earnings statement should he look at to determine if he will owe more money when he files his tax return? So take a couple minutes and think through that. Just a little check of whether or not we're following. This is actually a question we get quite often through the VITA program, and I got when I was in practice. Is, how do I know? What do I look at? I'm looking at this earnings statement, and there's all these numbers on it, and I don't even know what you're talking about when you say, have you paid in enough at the end of the year?
It looks like we have about 60% of people that participated, or we just got a bump.
So it looks like most of you have answered federal withholding tax, and that's exactly right. So if we're talking about prepayment of Bob's federal income tax, what we're worrying about, what we're concerned with on your earnings statement is how much federal income tax has been withheld so far for the year. All right, so what happens if you don't do this? If you don't prepay your taxes, you're going to owe more money when you get to tax time. So when you do your tax return, if you haven't prepaid taxes, you're going to find that you have to pay a big chunk of money at sometime in March or April, typically. But also, if you continually fail to pay enough throughout the year, you're going to be subject to some penalties. So there are penalties assessed if you do not prepay at least, and the IRS gives you two amounts. So it's whichever of these is lower, you have to prepay at least 90% of your current year net tax liability, or 100% of your prior year tax liability, net tax liability. So the IRS gives you two numbers, two ways to hit this target to avoid, again, these penalties don't apply unless you owe significant amounts of money. It's over $1,000. So if you owe a little bit of tax, that's not going to be a problem. But if you owe large amounts of tax at the end of the year, and if you continue to do that, so they give you 1 year of, we realize you didn't know that you needed to do this, so we're not going to penalize you the first year. But if you continue to not prepay your taxes, you will have penalties. The rates of the penalty vary based on the federal interest rate at the time. So right now they're higher than they have been in the past. But as long as you prepay the lesser of these two amounts, then you won't have any penalties, even if you do owe some money at the end of the year. So why the two different amounts? The two different amounts because we don't know what our current year net tax liability is going to be until the end of the year. So that's an estimate, and we could be wrong. So they give us the ability to reflect from last year's tax, and we can know what that is for certain. And then we know exactly how much we have to pay to avoid penalties. But on the flip side of that, if your tax last year was really high and you don't expect it to be high this year, you wouldn't necessarily want to prepay that large amount. So you can prepay based on this year's tax. Again, knowing that it's an estimate and things could change, but you have the ability to do that so that you're not grossly overpaying in a year when your tax is going to be a lot less. All right, so if Marco has a net tax liability this year of $20,000 and last year his net tax liability was $16,000, then he's not going to be penalized as long as his withholdings from his job or other payers plus his estimated tax payments is at least $16,000. So his minimum required payment would be the lesser of 90% of this year's tax, which would be $18,000, 90% of $20,000, or 100% of the prior year's tax, which was $16,000. He just has to pay in the lesser of the two. So as long as between his withholdings and his estimated tax payments, he's paid $16,000 by the end of the year, then he's not penalized. One thing I do want to note is when I'm saying by the end of the year, it's really by those due dates. So the amount of underpayment at those four different due dates, April, June, September, and January, is where the penalties are going to be assessed. So it's not like you can wait till December 31st and make a payment. You have to have been making these payments throughout the year at those quarterly deadlines. All right, so how do we calculate how much we're prepaying? Again, we have two ways to prepay: withholdings and estimated tax payments. So how do employers calculate how much to withhold if you're an employer? You are going to fill out, or already have, if you're an employee, you're going to fill out a form called Form W-4. And whatever you report to your employer about your tax situation is going to determine how much tax they're going to withhold. So, for example, if you report to them that you are married, they are going to withhold less tax than if you report to them that you are single. If you report to them that you have 10 dependents, they're going to withhold less tax than if you report to them that you have no dependents. The same is true with some deductions that you're going to report to them. So what they're withholding is based on what you have told them about your situation. Those calculators and these forms are fairly good at estimating how much tax that you owe, but there are times where they're not going to do a great job. So the W-4 form can actually be filled out however you need it to be to make sure that the withholding is correct. So that means that you can adjust what you've selected on your W-4 if you're consistently not paying the right amount of tax. So you might want to consider revisiting what did I report on that Form W-4 if you're consistently getting really large tax refunds, because you wouldn't want your employer to be withholding quite as much tax if that's happening. The same is true if you consistently owe money when you're filing. You might want to revisit, what did I report on that W-4 form? Did I report that I was married and they're withholding too little tax? Or, I could change that. I could report single. You don't actually have to lie. The form actually says report to your employer that you are married, but you would like them to withhold at the single rate. You can do that. So you would want to consider making some changes then, but also consider making a change to your selections if you have a life change, like getting married or having another child. You might want to think about changing those. Those selections can typically be changed anytime during the year. That's between you and your employer. But I believe that can happen anytime. If you need help estimating what your withholding reporting should be, there is a calculator on the IRS website. You can see the link here, and that will help you estimate what you need to report on that Form W-4. So, how do you know if you need to pay quarterly estimated tax payments? That gets a little more complicated. Again, if you owe more than $1,000 in taxes when you get to the end of the year and you do your tax return, you should have paid quarterly estimated tax payments. You can make quarterly estimated tax payments if you owe any amount of money, just to make sure that you don't have to pay a big amount at the end of the year. So even if you owed $800 at the end of the year, you could have paid $200 each quarter so that you didn't have to pay that $800 all at once at the end. But if you owe more than $1,000, you have to do that in order to avoid being penalized. So how do you know before you get to the end of the year? Again, you're going to estimate your tax liability quarterly, and that involves knowing how to calculate your net tax liability, and keeping good records of your income and your deductions. All right, so who generally has to pay quarterly? Again, employees that don't have other types of income a lot of times do not need to. I'm not going to say never need to. Sometimes you are not withholding enough tax, um, and so you would need to prepay. But if that's you, you could also just adjust your Form W-4 reporting so that your employer is withholding more rather than making quarterly estimated tax payments. But if you have income that's not subject to withholding, you will most likely need to make quarterly estimated tax payments if it's any significant amount of income. So some of those would be retirement income. Again, you can have the option of withholding on that, but it's not required. Gig and contract work. So if you are an Uber driver or if you have a consulting uh, obligation with that you're getting paid for. If you own a small business, if you have significant amounts of interest, dividends, capital gains from investments, or if you have taxable scholarships, fellowships, and grants. And this one is the one I think that catches students most often and that they're surprised by. So if you have any of these kinds of income is the time when you might want to consider making estimated tax payments. All right. So if you have gig work, contract work, or a small business, so if you are self-employed, you will most likely need to pay quarterly estimated tax payments. So this would include things like Uber, DoorDash, consulting, things like that, where the payer is not withholding any taxes and it's your obligation to prepay those taxes. So in order to do that, you need to be diligent in keeping track of all of your income because you may not always receive a tax form to tell you how much income you had. It's your responsibility to keep track of all of your income and report all of it on your tax return, even if you do not receive a Form 1099 or other tax form, that income is still taxable. One thing that people often think is that if I didn't get a Form 1099, it's not taxable. That's not true. It's taxable. There are just limitations on who is required to give you a Form 1099. So the other thing you need to keep track of is your business expenses. So you can deduct expenses of your business like mileage or supplies or parking fees, things like that. And so you'll want to keep good records of that as well in order to calculate and estimate your tax liability. Education assistance is also taxable in any form that it's received, whether you get a check, whether it is paying something that you owe directly to the university, it is taxable unless two things are true. You were not required to perform any services in exchange, and I know that gets a little tricky, but if you're not directly required to provide services in exchange, then it may not be taxable. And the other thing is that the assistance needs to be used to pay qualified education expenses. So you weren't required to do any work directly to the payer in exchange for it, and it was used to pay qualified education expenses. If those two things are true, it's not taxable. Otherwise, it is taxable. We're going to talk about tuition waivers in just a minute. There's a couple caveats to that. So what is a qualified education expense? It's mainly your tuition, but it's also fees and books, supplies, and equipment that are required for your program of study. So they have to be required for your program of study. Some of the fees the University of Illinois, particularly that charges, are required for your program of study, and some are not. And so not all of the fees you pay are going to be qualified education expenses. Same with books, supplies, and equipment. They have to be required for your classes. What is not a qualified education expense, though sometimes I know it seems unfair, but room and board is not a qualified education expense. Neither is food, research expenses, travel, conferences. These are not qualified education expenses. Um, Somebody asked me, health student fee, is that a qualified education expense? I do not believe that it is. Andrea might be able to answer that better from
No.
the withholding side.
Yeah, so I think that qualified education expenses gets really tricky as a a term itself.
Mhm.
We're specifically referring to qualified education expenses as defined by the IRS.
Yeah,
There are some qualifying education expenses if you're paying through a 529 plan that are not the same
that is
as
true.
what we're referring to with this particular webinar.
Yeah.
So if you're paying through a 529 plan, the 529 plan determines what types of expenses you can get disbursements from the top 529 savings plan to pay for your education. So
Yeah,
there's
and
some more.
actually,
Go
I'm
ahead,
sorry.
go ahead.
Actually, the IRS defines that as well. They just unfortunately define it differently.
Mm-hmm,
So there are
mm-hmm.
different things that they allow to be paid through a 529 plan versus eh, so that these qualified education expenses are also the same ones that are allowed if you pay them out of pocket as a tax credit, but also to make your education assistance tax free. So we actually linked you to in the slide or in the chat, I believe publication 970 that has all this information about what is a qualified education expense and what is not.
Absolutely. And it is confusing because the IRS defines the 529 plans, but this
Differently.
is related to tax credits and liabilities specifically.
Yes. Yeah. So these qualified education expenses are per the IRS definition of what is allowed to be provided to you as education assistance without it being taxable. So it's a different definition.
Yes.
Yeah. Great. Good question. All right. So, how does education assistance work with withholdings if you are an employee of the university that's providing you the education assistance? So, if the University of Illinois is your employer and they're providing you free tuition, free service fee waivers, then there may be tax withholding on some of that because if it is a taxable benefit to you, they are required to withhold taxes from that, the value of that in some situations. And I know Andrea's going to talk a little bit about how sometimes that gets tricky with your paycheck because they're withholding taxes on a bigger amount than what you're being paid in cash. And so sometimes your paycheck can be very small or even non-existent because it's being used to cover your tax obligation. So scholarships, fellowships, and grants you receive may be taxable. Withholding is sometimes done on this, but not always done on these payments. And so if you have if you do not have taxes withheld on these, that's when you might need to pay these quarterly estimated tax payments. So you need to be careful to know what is taxable, but also which things you're already having taxes withheld from and which things you are not. This education assistance may or may not be reported to you on any tax form. So, for example, if you get a scholarship and it goes through the University of Illinois Financial Aid Department, it will get reported to you on a tax form called Form 1098-T. But if you get a scholarship, maybe from, I've seen this a little bit in terms of um, uh, employers maybe giving a scholarship directly to an employee versus giving it to the university for that employee on their behalf, then that won't be reported to you on any tax form necessarily. Sometimes you might get a letter, sometimes you don't get anything, and you just need to know, hey, I had this scholarship as well, and this was taxable. So, tuition waivers are a little trickier because tuition waivers are given to someone in exchange for being an employee, typically of the educational institution. Tuition waivers, even though they're being used to pay tuition, by general definition are taxable because they require your service in exchange. But there are two exemptions from that. One of those is that every employee can receive up to $5,250 in tax-free tuition waiver for themselves or for their dependents. And then also another exemption is, or exclusion is that there are certain types of waivers, specifically some certain types of graduate student waivers that are tax-free, or maybe Andrea can speak a little bit more to that. Undergraduate student waivers, maybe. There are certain waivers that are tax-free. So that will be determined by your employer and reported to you. So from my end, the person who helps you do your taxes, I know what is and isn't taxable because I can look at your tax forms and see what the university has decided is and isn't taxable to you. On Andrea's side of things, that who is responsible for she knows a lot more about who the payer, the university, and what they're doing. There are certain ones that are, certain ones that are not taxable. But again, that gets into some specifics about your specific tuition waiver that we won't necessarily address. But there is a video that does address that we're linking to you in the chat that walks you through all of that. Andrea, is there anything you wanted to add there?
I just want to emphasize that for anyone that has a graduate assistantship or a pre-professional graduate assistantship or a combination of assistantships that includes graduate assistantship or pre-professional graduate assistantship, you should watch our video on our website or on YouTube specifically about the taxability of graduate level tuition and service fee waivers, because you will see a potential reduction in pay during October and November and possibly December paychecks of this semester, or March, April, May of the spring semester. Some students don't see a reduction in pay because they might be in-state students and have lower tuition costs. So the waiver amounts don't exceed that $5,250. So they might not see a reduction in fall. And since tax year is the calendar year, it starts over in January. So you may not see a reduction in spring. But if this is your second year of the program and you have assistantships, you might see a reduction this semester that is way more significant than you've experienced in your prior academic year. So that's why it's really important for you to understand so that you can budget ahead of time. And we'll make sure to send the link to the recording for that video as well when we send out this recording.
Great.
I hope that that provides a little more clarity on why it's important to know what type of assistantship you have so that you can help figure out your tax liability for a budget situation.
Right. Yes, exactly. And the other thing I would say too is that if you're joining us from not outside of the University of Illinois system, sometimes the titles of assistantships are they're not always the same, and so you need to know how yours is classified. So just be careful of that.
And the process of withholding differs at other institutions as well, just because of the way that our semesters and the deadlines work for applying both assistantships and you know, the waivers themselves. They can't actually run a withholding query to see who has an additional tax liability until the October paycheck for the fall. So that's why it's only spread typically over 2 or 3 month period. It's typically just over 2 month period, but you can learn more by watching our video.
Yeah, I would recommend definitely watching all of the videos that we're talking about because it is a big issue and it takes way more time than 1 hour to explain. And so there are multiple videos that you have access to kind of walk through this.
Absolutely.
All right, so how do you calculate taxable income? If you need to estimate your tax liability, you need to be able to calculate your taxable income. Again, we kind of talked about this at the very beginning, but I want to circle back to it now that we've kind of walked all the way through the process. But the first step is to know what income do I have that's taxable and what income do I have that maybe is not taxable. If you're unsure about your scholarships, fellowships, and grants, we have a webinar that just talks about those things. If you're unsure about your tuition waiver, then watch this video that we just linked in the chat as well. You also need to be able to calculate or know what tax deductions and tax credits you're eligible for, and then be able to calculate your next net tax liability based on your filing status, determine what credits you're eligible for, and then you're going to look at, okay, here's my net tax liability. Has my tax withholding been enough? Or do I need to make some quarterly payments? So you're going to do this on a quarterly basis, and whatever shortfall you might come to when you're making this estimation is your quarterly tax payment. So you can watch our video if you need help calculating taxable income. But that's the first step to knowing, do I need to make quarterly payments or have I had enough taxes withheld? All right, so if we have Catherine has some income from two different things. She delivers pizza. She's an employee of a pizza restaurant, and she's a pizza delivery person. And her employer has withheld $10,000 of federal income tax. And they also DoorDash, which is gig work. She's an independent contractor. No taxes are withheld. And so she's going to estimate her total taxable income and estimate her total tax liability. Again, she's doing this quarterly, but she's going to do it based on, what she thinks for the whole year. If she estimates a tax liability of $22,000, then she would have a shortfall of $12,000. So she estimates for the whole year she's going to owe $22,000 and her employer is going to withhold $10,000. And so she needs to make up that shortfall. So she has to pay $12,000 throughout the year. So not at the end of the year, but she needs to do that throughout the year. So she's going to pay $3,000 on April 15th, $3,000 on June 15th, on September 15th, and on January 15th of the next year. Now, having said that, she can adjust that estimate. So let's say that she's doing this at the beginning of the year. She's expecting, okay, here's my net tax liability that I'm expecting. Here's the withholding I'm expecting. And she makes a payment of $3,000 on April 15th, and then on June 15th, and then by September 15th, she has more information because she's more, we're almost all the way through the year, and she thinks that that estimate is either too high or too low. She can adjust that estimate and make different payments on September 15th and January 15th. She's not stuck with the $3,000 just because she made the first two payments of $3,000. All right, so another quiz here for us. A few questions just to kind of wrap up and see where everybody's at in terms of their understanding. Which of the following types of income will likely require you to make quarterly estimated tax payments? So if you had wages from a university job only, would you be required to make quarterly estimated tax payments? What if you had fellowship stipends and grants or scholarships that were used only for tuition? Second question, what's your next step after this webinar? Just a free response question. And how confident do you feel about managing your tax obligation after this webinar?
Looks like we have about 35% of participants that have participated. And that's jumping up. Don't forget to scroll down a little bit and hit submit if you've made your selections. I like that no one's at a 0 as far as confidence level goes. So that's excellent. All right, I'll go ahead and end the poll and share the results real quick.
Great. So which of the following income types would likely make you require you to make quarterly estimated tax payments? The answer is, I guess B. I don't see the numbering, but fellowship, stipends, and gig work income. That's when you need to be careful about do I need to make quarterly estimated tax payments? If you've only got wages from a job, most likely your withholding are going to be enough to cover your obligation. That's not always true, but it is most of the time. If you have scholarship money used only for tuition, again, that's not going to be taxable. And if you have none of the above, obviously you have no tax filing obligation. So great job. Looks like everybody is feeling a little more confident, hopefully, about their tax filing or their tax payment obligation. But I think we're going to share some other resources for you that you can use. And I'll hand it over to Andrea now to talk about those.
Thank you, Mandy. So you can watch any of our tax-related webinar recordings or videos on YouTube. We are IL Student Money on YouTube. We'll also be sending all the links we shared in the chat with the webinar recording from today, once it's been captioned appropriately for accessibility and loaded to YouTube, which can sometimes take a couple weeks or so. As far as action items go after this webinar, hopefully you will check your withholding status for your different income sources, whether that's your job or contract work or retirement income. You're going to hopefully estimate your tax liability and pay any estimated taxes this year if you need to. You want to make sure that all of your addresses are updated for employers, contracting entities, retirement, income providers, or financial institutions. And you can watch another one of our Get Savvy Tax webinars. If you can, let us know how you feel, how we did with today's webinar survey. We're going to drop that in the chat real quick. Again, we're really plugging the webinars on YouTube. You can also get to it through this short URL, go.uillinois.edu/getsavvy. And we have lots of collaborators on the Get Savvy webinar series every year and we're excited about this year's lineup of collaborators. We'll stick around for questions, but we know we went over a couple minutes. So if you need to move on to the next thing or go get a snack or lunch, go ahead. We'll make sure to include the recording with any questions that we answer in a couple weeks. All right, we already got a question in the Q&A. Do you want me to ask it of you, Mandy?
Yes, please.
I had an out-of-state internship one summer and had to pay state taxes for both states, the state I did the internship at and Illinois, and that ramped up to become a large amount of tax that I am unsure where I went wrong. Addressing how to do state tax in multiple states would be really helpful. We can only really address Illinois state tax. Trying to do that for 50 states is kind of intense, but if you have any additional insights, Mandy.
Yes, yes. So one thing, so again, Illinois is what I know best in terms of the rules, but most states work the same. And how that works is that you are taxed in the state where you're doing the work, and you are also going to be taxed in the state that you are a resident of. So this, if you're a permanent resident of Illinois, you're going to pay tax on all of your income in Illinois, no matter where it's earned. But if you pay tax to another state, then you would get a credit in Illinois for the tax you pay to the other state. So if you paid tax in both states, um, and didn't get a credit for the tax you paid in the other state in Illinois, your resident, your home state, then you might want to revisit that tax return and just see if maybe there's a an error that was made. So you shouldn't pay double tax, but what you will have is if you're a resident of Illinois, particularly, you will pay tax at the Illinois rate on that income. So if the other state's rate is lower, you'd pay more tax than if you were a resident of that state. But it shouldn't be, you shouldn't pay, you should get a credit for the tax you pay in the other state.
Thank you, Mandy. That's why you have you as the subject matter expert and not me. Kathy, were there any questions asked in the chat that you think we should address?
I think I think this was one of those webinars where there was a lot to take in and it was hard for people to think of questions at the same time. So I just want to encourage people that if you do think of questions, reach out. We could try to help you. So I think I did answer a few privately, so I think we're okay. We just got another question, which are, what are some tools highly recommended when doing taxes? And I'm going to throw that one to Mandy.
Some tools. So I think these webinars really are great tools for just understanding the basics. I think that you can, if you qualify, we can help file your tax return through the VITA program. If you need help with that. If you don't qualify, we can also provide you some resources on how to select a paid tax preparer. So if you aren't sure, you can come out and see us in February, and we can help you in that way. But I think the IRS provides so much information on so many different topics. It can get overwhelming, but the information is pretty good. The publication 970 that we linked in the chat that talks all about how scholarships, fellowships, and grants are taxable. It's actually a pretty easy to understand. All of the, if you see something that says IRS publication such and such, those are usually written with the intent that the taxpayer can understand them. So I wouldn't shy away from using those resources. But I would say that if you need help, come see us in VITA first, and we can direct you elsewhere if we can't help you. But that would be my suggestion.
And I know we had a bunch of Chicago folks on. There are more VITA sites in the Chicago area during the spring. And there's a tool for you to search for VITA sites as well. That's linked on our website, and we can make sure that it's included in the link sheet when we send out this webinar recording as well.
Yes, and you can look for in the Chicago area, it's called Ladder Up. They run a lot of VITA sites in the Chicago area.
Yes, and I believe they also have an online tool as well that we link to on the Student Money Management Center's webpage for taxes.
Yes. Yes.
And I put some of those links as you were all talking into how to access these different free tax preparation sites.
Thank you so much. Emmy, can you also grab the web page for taxes from the Student Money website and link it in the chat? Thank you, Emmy. So that one might be helpful since we've curated all the statewide resources for anyone in Chicago or Springfield that might be joining us.
Wonderful.
All right. Mandy, any words of wisdom to leave the remaining participants with?
Yeah, I think my word of wisdom is just to plan now. So the title of the webinar is Prepay or Prepare to Pay. So I think prepaying starts now. So I would take a look at your situation now. You've got 2 more quarters to make quarterly estimated tax payments if you need to, and the sooner you do that, the smaller your penalties would be if there were any. So I would definitely not wait until tax time to be thinking about that, but just start thinking about it now.
All right. Thank you, everyone. We'll go ahead and close everything down, but don't forget that we will be sharing this recording when it's available.